All right, why don't we go ahead and get started? So thank you guys for joining. My name is Mark Lamonic. I'm the product manager for Morningstar Premium, morningstar.com.au. And today we're going to talk about alternative investments. So something a little bit different. Had a couple questions about them. So we thought we'd cover this topic. But yeah, we'll see how it goes. So anyway, housekeeping items first. So anything you hear today is general advice. I don't know anything about you, so I can't offer any personal advice. If you're over in New Zealand, get a copy of our FAP by going to our website, morningstar.com.au. And finally, if you're in New Zealand or anywhere and you would like personal advice, you can, of course, reach out to a financial advisor. All right, so let's get started. And a big thank you to Shani for creating today's deck, which I very much appreciate. And you can follow us on Instagram or listen to our podcast. Let's see. All right, we're going to talk about alternative investments today. So first, a definition. So when we look at the investing landscape, we have traditional investments. So of course, stocks, bonds, cash, generally long only. So meaning that we are investing the way you think you would invest, that prices go up, we benefit. When we turn over to alternative investments, we are looking at a couple different things. So one, we have kind of legal structures that are also ways to invest. So an example of that is a hedge fund. At the end of the day, a hedge fund is just a legal structure. You could start a hedge fund and have a long-only portfolio that's exactly the same as a managed fund manager. Or, of course, you could do what traditionally people do in hedge funds, which is using short positions as well. So we'll get into all of that, but it is both legal structures and approaches to investing. And we're going to talk about sort of why and the categories that you would put alternative investments into. But one thing that's important to note is that they are really popular and growing in popularity. So in 2016, there was about $10 trillion US dollars under management in alternative assets. By 2025, they expect that to get to 21 trillion. And it falls in all these different categories, as I said, that are just basically different from a long-only portfolio of stocks or bonds or cash. So overall, and we'll get into this a little bit as well, generally speaking, and they come in a lot of different flavors, so we'll use a lot of generalizations today. Generally speaking, an alternative investment would be something that you would expect to outperform in poor market conditions and fall behind, not perform as well in strong market conditions. So obviously what we've seen lately are very strong market conditions where the stock market's going up. So we'll get into some detail on this next slide around returns. All right, so what are the typical characteristics? So once again, these are all generalizations. Low correlation to traditional investments. So what does that mean? So typically low correlation to traditional investments means that they have a diversifying effect on a portfolio. All right, so when we look at correlations between, think of any portfolio, correlations between different asset classes, we want to diversify widely. We are looking for assets that potentially have low correlations. I'll talk about the implications of that and when that's actually useful. So in many cases, you are taking on more risk in some of these alternative investments, especially because you can use things like leverage, so borrowing money to invest in these portfolios. That, of course, does increase the risk, but potentially gives you higher returns as well. So something to think about. Liquidity. So liquidity is very important. So if we think about more regulated financial investments, so if we think about managed funds, for example, think about ETFs, they are highly liquid, meaning you can get your cash out of them relatively easily. So everyone even talks about managed funds and how they are less liquid because maybe it takes you a couple days to get your cash. But compared to a lot of these alternative investments, they are very, very liquid. So if we think about liquidity and how that kind of plays into an investment portfolio, there's this concept known as the liquidity premium. And what it basically means is that investors will accept lower returns for higher liquidity. So liquidity, once again, the ability to get cash out of an investment, just like with an ETF, very liquid. All I have to do is wait for the market to open and I sell it. And then all of a sudden I've converted into cash. That's an example of being very liquid. So there's this notion of a liquidity premium, basically that you will get higher returns by accepting lower liquidity. And a lot of pension funds and university endowments and different investors like that, generally institutional investors, believe that, okay, if I don't need the money, I'm a long-term investor, I'm truly a long-term investor. If I'm an endowment, which is sort of investing for a perpetuity, or same thing for a pension fund. So I'm truly a long-term investment and I accept less liquidity, I'll get higher returns over the years. And basically a lot of this is, simple examples that people can refer to as like private equity, right? Where there are long lockups, meaning that you literally cannot take your money out for maybe 5 years or so while they're actually making those investments. And that's at the sort of long end. But then when we get on to even alternative investments that are more liquid, we're talking about potentially not getting your money back. You don't get daily liquidity. So maybe you'd have to wait a month or a quarter before you get your money back. Maybe these things are not priced very frequently. So all the things that we sort of see in the stock market overall, or with ETFs or even managed funds, what the price is, easy to get your money back. A lot of this doesn't exist in some of these investments. Also, they're typically harder to access. And we'll talk a little bit about access later, but there's generally higher minimum investment requirements, meaning you have to put more money in. The other really important thing to think about with these, and will be kind of a recurring theme as we go throughout these, is we've all, of course, heard stories about hedge fund managers that do very, very well and have done very well over years and years and years. The question for you, of course, obviously, I don't know about your finances, but are you ever going to get access to any of those great managers? Or have the lesser managers just sat there and copied the concept that, very famous hedge fund managers have used, and then tried to sell it to individual investors for higher fees? I will say that maybe I'm more of a skeptical person, but I'm more on that side of things. There are certainly very, very intelligent people out there investing that have a knack for this and do a fantastic job. My question is, can I get access to some of these alternative managers as an individual investor? And yeah, I'm skeptical that I can, just because, I believe that, obviously they don't want to deal with the constraints of working with individual investors. So it's a lot easier to go out there and collect $1 billion from some giant endowment than it is to go out and sell in $25,000 chunks to a bunch of individual investors. But anyway, that's just me being skeptical. Okay, so we've got some examples of returns here. And what we're looking at here with these different returns is we're looking at how alternative portfolios, and once again, this is a wide term, have performed during different periods of time. So I like this one down on the bottom because we're going through a couple examples that we probably all know about. So why don't we talk about the tech bubble? So you can see in the tech bubble, now we've got four things. I'm not great with colors, but we've got this one, equities, so just investing in shares, fixed interest, a 60-40 portfolio, so thought of as a traditional portfolio, although most people don't use that anymore. So a 60-40 portfolio is 60% equities, 40% bonds. And then, of course, we have alternatives. So you can see during the tech bubble, where do you want to be? You want to be in equities until the tech bubble bursts, where you can see outperformance by alternatives. Same thing. So the run up to the financial crisis, see the same thing. It fell. Alternatives did not fall as much. And yeah, so basically you've got this pattern where some of these alternatives that do have low correlation to traditional investments have done better during times of crisis and overall have done pretty well, right? Although not by a lot if you sort of look at this chart. All right. Let's keep going. Well, my slides don't ever want to advance. All right, so why are investors turning to alternative assets? I'll go through a couple of high-level reasons, and then we'll throw in a couple more as well. So one, obviously, is just this notion that historically speaking, equities are very expensive. So, people are, of course, worried about expected performance into the future. Now, this is a concept. I feel like when I keep saying this, I get a lot of questions. But the higher the valuation level of equities, the lower expected returns we have in the future. So, simple way that I try to explain this that sometimes resonates is we go back and we look at the market over time, and we look at the average returns of the market. If the market continually in recent history outperforms that average return, we believe that average return represents what you'll get overall in the future. That means mathematically the market's got to fall. You can't have above average anything for an indefinite amount of time. Now, the counter argument is that the historic averages are too low and they should go up. But I think it's just sort of what you believe. But anyway, we have seen over time that the market does fall, and we haven't had it fall a lot in a long time. So as you get higher and higher returns, it does lower future expected returns. So we can see that from the valuation level as well, right? If I'm an investor, what am I paying for? I am paying for whatever it might be, earnings, cash flow, all of that. If I'm paying a lot more for that as an investor, then I can't expect to get the same returns in the future. Same thing with dividends. I'm getting lower dividend yields, and dividends make up a large part of historic returns, more than half, then I can't expect returns to be as high as they were in the past. So I think people are looking at equities saying they're pretty expensive. Low interest rates. So of course, if you are a fixed interest investor or a cash investor, you are sitting there thinking, I'm not getting paid anything. So what can I do? Where can I put my money that's still maybe relatively safe? You think traditionally about bonds and cash. What is the purpose of them? The purpose is to lower the volatility in your portfolio. And now you're searching for other ways to lower the volatility in your portfolio, but hopefully getting a little higher returns. And then this last one is inflation, of course. So investors are looking at inflation going up. So regardless of, what central banks have said about how they're comfortable with higher inflation, I think kind of everybody is watching with a fair degree of interest to see where inflation will go. But a lot of these alternative investments potentially have inflation hedges built into them. So that's something that we should look at as well. All right, so we're going to categorize them into 3 different categories. All right. So what are we looking at? We're looking at modifiers, diversifiers, and opportunistic. All right, so let's talk about this. So what is a modifier? A modifier is basically taking standard risk factors that we're all aware of as investors, or should be aware of as investors, but we are using techniques like shorting securities, derivatives, things like that, to try to make sure that, or to try to prevent large losses in falling markets. So that's really the approach that we're taking now. So let's use an example. Like we can use this long short equity. So long short equity can be any way you want to define it. A simple way is just if you are looking at an index fund, you can sit there and go long on an index and then go short a certain percentage. Now, why would we do that? Well, basically what we're doing in that case is we're lowering the beta of our overall portfolio, so that if the market does fall, that portfolio will not fall as much. Now, we've been hearing this term forever. People remember, I can't say I remember, but if people remember the 87 crash, what was a lot of that? It was something called portfolio insurance. So it's the same notion, right? That it's protecting you on the downside. Now you can do that long short equity. You can do that with derivatives. So options, for example, you can do that with certain put strategies to limit your downside. So all different things you can do. Now, we put down at the bottom, or Shani put down at the bottom, what's a way that you can do that without using alternative investments? Well, simply cash, right? So there are easier ways to do this. And once again, this is going to potentially be a theme as we go through here, that I'm a little bit skeptical about the use that these would have in many investors' portfolios. So what do we mean by replacing that with cash? Well, I can describe a very complicated option strategy that you would put into place to protect your portfolio in a falling market. But the other thing you can sit there and do is just hold more cash, because cash will protect your portfolio in a falling market. If I'm 0% cash and the market goes down a lot, my portfolio is going to go down a lot. If I'm 20% cash, what's going to happen? My portfolio is not going to go down as much. And so I think this is an opportunity for us to think about what are some cheap potential tools that we can use, cheap and simple tools that we can use to get the same effect. So that's what you're trying to do with a modifier. And the important thing to think about modifiers is, yes, there are times in people's lives when this is very important. But for the vast majority of the time, the market goes up. So me shorting the market, and we'll talk a little bit about this equity market neutral thing in a second, which is a different shorting strategy, but me shorting the market, me investing in some bear ETF that moves inversely to the market, me using a bunch of puts and different derivatives to try to protect me on the downside. A lot of this over the long term, we know isn't going to work, because the market over the long term has traditionally gone up. If that's what you believe it's going to do again, you are just detracting from your returns to protect you during periods of volatility. Now, maybe that's really important to you if you're approaching retirement or you're approaching a goal, but for most investors that have longer time horizons, probably not as useful. All right, so let's talk about diversifiers. So the diversifiers is looking at a broader set of risk factors than you would traditionally get with shares and bonds. So, yeah, I mean, that's basically it. So let's go through some of these. Let's go through some of these examples. And the non-traditional risk factors, of course, means that your portfolio is more diversified. So just remember, the whole point of diversifying anything is, why do I buy shares in Australia and Europe? Well, if I just buy shares in Australia, I am very, very exposed to any downturns in the local economy. But if I buy shares in Europe, it's a different economy. We're all connected in some ways, but it is a different economy, and that provides me with some diversification. Well, this is taking that to a further extreme. So what are some examples of that? We've got equity market neutral. So what is equity market neutral? It basically means, in a simple example, is through shorting or through derivatives, I can remove market risk from my portfolio. So if we look at the two different types of risk, we've got market risk and we've got security specific risk. So market risk is just the fact that as investors in the stock market, we are taking on market risk. We want to do that. We want to do that because we take on risk to earn returns. And then there's security specific risk. It's why I don't put all of my portfolio in one share, one company, because then I'm very, very attuned, or then my portfolio is very, very connected to obviously that one company and how it's going to do. So what is a very simple example of an equity market neutral position? I take two shares that do roughly the same thing. So I look at the banks in Australia and I go long CBA and I go short NAB. So what am I doing there? What I'm doing is I have made a judgment call that I think CBA is better than NAB. Now, what a traditional long-only investor would do is, if they said CBA was better than NAB and they think it's going to have better returns in the future, they would just buy CBA. But that still means that I have risk out there based on the overall market. The theory is that if I go long CBA and go short NAB, all CBA has to do is outperform NAB. It doesn't matter if it outperforms NAB by going down 10%, where NAB goes down 15%. It doesn't matter if it outperforms by going up 20% and NAB goes up 15%. I found the quote unquote better bank. What I'm doing is I am just concentrating on my judgment call that CBA is a better investment than NAB. And that's where I'm concentrating my portfolio, not worrying about everything else. interest rates, the general market, an economic recession, anything else that could impact banks. So that is an example of going market neutral. And you can do that in all sorts of ways, right? I used a very simplistic example, just a pair off of two securities. But yeah, there are other ways that you can do that. Yeah, the rest of these are pretty much similar. I can do the same thing with options. So all those option strategies that involve both puts and calls, I can create, they have all these crazy names. I can create all of those situations, which once again are complex to do, but we'll get into that. I can create those situations where, I've basically removed a lot of the regular risk from portfolio, anything that's sort of volatility related. I can buy options on volatility that I don't know if the market's going up or down or where it's going to go, but I do know that I think it's going to bounce around a lot and I can profit off of that volatility. So all different options. So diversification, kind of traditional diversification, is also an opportunity for you. So just make sure that you're exposed to a lot of different asset classes, a lot of different geographies, et cetera. All right. So opportunistic strategies. So basically what these are looking for is absolute returns. And what we're trying to do here is we are trying to create a portfolio that will perform okay in any environment. So basically that it will go up in any environment. Now, it's not going to go up as much, obviously, as a portfolio that's just long only equities, but that's the intention of what these managers are trying to do. And once again, there's lots of different strategies that people can use to do this. But as investors, what do we think about this, right? So absolute returns and capital preservation. So that, again, is protecting you from volatility. So as investors over time, if markets continue to go up as they have historically over long periods of time, over time, and if we have time into our goals, maybe we don't care about this as much, or we shouldn't care about this too much. We shouldn't be as focused on volatility. All right, moving right along. So what do you need if you decide that you want to invest in an alternative strategy? What are some of the things that you should look out for? One thing is, much like our complaints, mostly my complaints about thematic ETFs, is you see quote unquote lineup churn. So you see a lot of different strategies coming and going over time. So these things are definitely trying to take advantage of either narratives that people have about the overall market or just trendy investment techniques. Once again, sort of the same notion that somebody out there, some hedge fund, did really, really well with one of these strategies. So now everyone's going to try to copy it and make it available for retail investors. Well, yeah, once again, that's kind of chasing returns and chasing a trend, which may not necessarily be the best approach. The other problem is this idea of liquidity mismatch. So we talked about how a lot of these funds have do lock you in for longer periods of time, and potentially it's harder to get your cash out of them. But there are certainly situations where there have been strategies that may have worked over the long term, but there was a liquidity crunch that caused them to fail. So one of the most famous examples is long-term capital management. So long-term capital management, I believe this is around 98 or so. It was a hedge fund. It hired all of these literal geniuses, so all these people that won Nobel Prizes, and they created this very, very complicated and very, very levered, which we'll get into in a second, hedge fund that was investing in fixed income mostly. Well, turns out they ran into a little bit of a liquidity problem. And they ran into a liquidity problem that basically, before their strategy, which would have eventually worked, before their strategy could play out, they ran out of money. And they had to start selling stuff off at fire sale prices, almost brought down the global financial system, and there was a huge bailout. So that's sort of an example, once again, how liquidity can play out in some of these. So there was a liquidity mismatch about how long their investors wanted to stay invested and how much money they were willing to put into this, and when this return would actually come to fruition. All right. Oh, so John said, diversification. Is that a typo? No, that is just a clever little saying. I'm the one that makes typos all the time. We'll get down there. No, Shawnee is obviously a lot better at all this stuff than me. So yeah, that is not that's not a typo, but we'll get there. So I'm not going to go through all these, but obviously complexity and leverage are issues as well. So leverage can be great on the upside. So borrowing money to invest. So that's great when markets are going up. Can be a real risk when markets are going down. Complexity, I mean, at the end of the day, very, very complex strategies. Even the smartest people trying to execute those can make mistakes. That complexity also can certainly confuse some of the not so smart investors that are out there in some of these products. And the complexity can also confuse you as an investor that's putting your money into this. And you don't understand it, so you sort of take people's word that this thing is going to work. Fees, I'm just going to hit a couple of these fees. The fees are generally a lot higher in all of these strategies. That's why everyone wants to do them. So fees, as we know from any investment, whether we're looking at an ETF that's very simple or something that has very high fees, those fees are returns that you're not getting. So over time, of course, those fees will they will erode the returns you're getting, which sends compounding in the opposite direction. Well, let's go down to this diversification. So basically the idea is this, that as we're talking about over the long term, markets have gone up. So why are we trying to diversify away from this sort of traditional equity risk that has done very, very well? So that's the notion behind that. Basically, the more you diversify, the worse off you'll do in some cases. So particularly when we have these kind of prolonged bull markets. So, the very simple example is that, with a 60-40 portfolio, my decision to put 40% in bonds in a really strong equity market that's going up, that of course is going to impact me. So this is just playing that out even more as I go into all these very complex different strategies to try to, many ways to try to lower volatility. I'm just coming up with a better outcome. A worse outcome. All right, so let's say you're looking at alternative investments and trying to make a decision if they are right for you. So we have a couple tips from a manager research team when you start looking at these. So most of these should be fairly obvious, but yeah, you probably want to hire someone that does have experience managing an alternative asset. You probably want them to have a bunch of good investment professionals that are doing this, sound philosophy and process. This is kind of the no kidding slide. Risk management. So obviously, the more complex your strategies are, the better you need to be at risk management. You need to understand certain liquidity and leverage. So when can you get your money back? What is the impact of them borrowing a bunch of money on top of that on returns? And then, of course, as always, hey, it'd be good to have a compelling track record of strong risk-adjusted returns. So what we're basically saying at the end of the day with all of this is that anytime you're going for an alternative strategy, you are very much buying the person's expertise or the people's expertise that are investing the money. So these are active strategies, but active strategies to an extreme. So you need to look at the people that are investing the money and be comfortable with the approach they're taking. All right. Are they worth the trouble? Well, it's a good question. I would argue for most investors, no, they're not worth the trouble. Maybe they sound cool. Maybe it is great to go out there and speak to somebody about this at a barbecue or picnic. I guess that's what, at least in New South Wales, we're doing right now. Maybe it's great and interesting that you're invested in these different strategies, but what are the alternatives that you can do? What is the portfolio problem that you are trying to solve? And what are different ways that you can do that? So obviously the examples that we talked about, cash, looking at the true time horizon. If you're looking long-term, what gets washed out over the long term? And then what are your abilities to diversify? You can diversify in many different ways. You can certainly diversify across public assets. You can diversify into different things that are easier for you to invest in. So yeah, that's one thing to consider. And then, yeah, how are these actually adding value to you over the long term? So they all sound exciting, and that's what everyone likes when they're investing. But remember, we're just trying to be boring here. We're just trying to achieve our goals and earn whatever return is necessary to achieve those goals. All right, so we've got a couple examples on here. Now, a couple things to think about. So these are different products that our analysts have looked at, and you can see sort of their ratings across different pillars. So people, process, parents, all these are very important when you're looking at active managers. And you can see down here that many of them have pretty high minimums. So we just wanted to close with a couple different examples that you can use. So if anyone does want this slide deck and they're more interested, let me know. I can send this to you, and you can go research, including on premium. You can research some of these different strategies. Now you will see the highest analyst rating that any of these got was a bronze. So gold, silver, bronze do represent in this case funds that we do like here at Morningstar, but of course gold and silver, we have higher conviction than bronze. And probably a lot of this is based on fees, just because, as I said, you're going to pay significantly higher fees for any of these investments. All right. Look at that. We got through that one fast. We got a couple questions. All right, so Phil's asking, it would also be useful to make further distinctions of each investment category with respect to defensive, growth, income, aggressive strategies. Yeah, okay, so that's a really good point. So what I will say is, with a lot of these categories in here, many of them should be more defensive. And if we look sort of across each one of those, so let me go back to the slide deck. All right, so many of these across sort of modifiers and diversifiers are more defensive at the end of the day. There are certainly sort of long short funds that can be more aggressive. There are all these different categories. There are examples of investments that can be more aggressive, but traditionally a hedge fund, just like you would hedge currency risk, the whole point of a hedge fund is that they do have the ability to short the market. That was where hedge funds originally came from. Managed funds were not allowed to short the market. Hedge funds were. Now, the laws have changed since then, but that's the whole point of a hedge fund, that you were hedging something. All right, so we've hit 2 o'clock, so sorry about that. If you have any questions, you can email me, mark.lamonica1@morningstar.com. And yeah, I'll be back on Thursday to do a couple more of these. So thank you guys very much.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.